Last week I gave a fire safety talk, and nobody paid any attention. It's my own fault for using PowerPoint. PowerPoint is boring.
It's synonymous with the verb to copy, and it's used in offices everywhere. The Xerox Corporation has been around since the early 20th century, and it's still prevalent today, despite the fact that the world is increasingly relying less and less on paper. Xerox is known for revolutionizing the business world by producing the first plain paper copier, a technology that would change the way people work forever. The company purchased affiliated computer services for $6.4 billion in 2010.
In 1938, Chester Carlson, a physicist working independently, created a new process for printing images using a photoconductor-coated metal plate and dry powder toner. However, it would take more than 20 years of refinement before the first automated machine to make copies was commercialized. Joseph C. Wilson, credited as the founder of Xerox, took over Haloid from his father. He saw the promise of Carlson's invention and signed an agreement to develop it as a commercial product.
Xerox has been an inspiration to the photocopying business, and their success has been contagious. So contagious, I wrote a book about it.
During the 5 years spanning from 1997 to 2001, Xerox violated accounting standards by overstating its profits by nearly $3 billion. Now here's a clip to put that into perspective for you.
Stacy, can I come over after school? We can hang around and buy the Did your mom get back from a business trip? Is she there, or is she trying to give me the slip? And I'm not the little boy that I used to be. I'm all grown up now, baby, can't you see? Hey, Stacy's mom has got it going on. She's all I want, and I've waited for so long. Stacy, can't you see? You're just not the girl for me. I know it might be wrong, but I'm in love with Stacy's mom.
The issue was brought to light on April 11, 2002, when the Securities and Exchange Commission filed a complaint that Xerox was intentionally manipulating its revenue figures.
The main factor of this accounting violation was how the company had been accounting for its equipment leases. Instead of recognizing a portion of the revenue over the life of the lease, they were accounting for everything up front. This is in direct violation of GAAP's revenue recognition principle. As a result, Xerox inflated its net profits in order to achieve earnings estimates and please investors.
Xerox wasn't the only player at fault here. You see, all public companies have to be audited to make sure that they're following GAAP. And if there's anything I learned in accounting, if it's not GAAP, it's crap.
Not only did Xerox manipulate its financial statements, but its auditor, KPMG, let it slide. The accounting services firm had been auditing Xerox for over 30 years and was subsequently fired after playing a part in the accounting scheme.
By the end of the investigation, Xerox agreed to pay a fine of $10 million and restated its financial statements for the years 1997 to 2001. They issued a $6.1 billion restatement of revenues and a $1.9 billion restatement of pre-tax earnings. Their plan had been foiled and their stock price plummeted accordingly. Since the scandal, Xerox has never been quite the same. Let's take a closer look into how this happened, who was behind the whole mess, and where the company is today.
But wait, let's go back to that phrase, the GAP's revenue recognition principle. What does that mean? What is GAP, and why do companies have to follow it? Let's go back to the 1920s.
I am the Edison photograph. And not what your country can
The U.S. stock market was undergoing rapid expansion after a period of wild speculation, and the fair value of stocks had become extremely overstated. Stock prices began to decline in 1929, and investors panicked and attempted to stabilize the market by buying large volumes of stock. However, the bubble that had been created needed to burst. On October 29, 1929, otherwise known as Black Tuesday, the stock market collapsed and billions of dollars were lost, throwing the U.S. into the Great Depression. After this crash, the government knew that it needed to find a way to regulate the accounting practices of publicly traded companies. The SEC had the authority to set accounting standards, but decided to delegate the task to the private sector, which at the time was the Committee on Accounting Procedure, or the CAP. The CAP was later replaced by the Accounting Principles Board, which eventually gave way to the Financial Accounting Standards Board, or the FASB.
The FASB has been the major policymaking body for accounting principles ever since. The decisions that this board makes from the generally accepted accounting principles, or GAAP. GAAP represents the objectives and guidelines that public companies need to follow for their financial reporting.
Only public companies are required to follow GAAP, but many private companies do so as well because it improves the clarity of financial reports and allows for fair comparison. GAAP allows investors to analyze and extract useful information from companies' financials. And when GAAP is not being used, the SEC requires that the companies make their investors aware.
While there are many principles within the generally accepted accounting principles, we will only focus on the one Xerox violated, the revenue recognition principle.
This determines when a company can recognize revenue on its financial statements. It is a combination of accrual accounting and the matching principle, and states that revenues should be recognized when they are earned, not when they are received. It also states that any associated costs should be recognized in the same period as the revenues.
This all might sound confusing, but let's look at what Xerox did wrong to understand the revenue recognition principle.
Part of Xerox's revenue came from leases of equipment such as printers and scanners. There were 3 revenue streams that came from 3 leases: the value of the product itself, the servicing of the product over the life of the lease, and the financing revenue that Xerox received on loans to the lessees.
According to GAAP, Xerox should have immediately recognized revenues from the sale of the product, but spread out the servicing and financing revenues throughout the length of the lease.
Okay, great. So Xerox gets to recognize some of its revenue up front and some of it later. What's wrong with that? Well, Xerox wanted to make it look like its equipment revenues and earnings were higher than they actually were. They wanted to meet the high expectations of investors and wanted to keep in pace with competitors. So how exactly did they do this?
Beginning in 1997, they started to recognize servicing and financing revenues at the initial sale, which inflated equipment revenues and made it look like the earnings were above and beyond what they actually were. This is called cookie jar accounting or topside accounting and is not compliant with GAAP.
This seems like it could be harmless.
They're just moving forward the revenues that they eventually will get, right? Wrong. Let's take a look at the actual effects of this GAAP violation. Over the 5 years that this occurred, there was a $3 billion gap between actual equipment revenues and reported equipment revenues.
Pre-tax earnings were overstated by $1.5 billion. And by 1998, $3 of every $10 of pre-tax earnings were because of this accounting violation. Without these accounting actions, Xerox would have fallen short of earnings expectations in every period from 1997 to 1999.
So that's a pretty big deal. If investors see that Xerox is continuing to make profits, then they're going to continue investing in the company. If public companies are expected to follow GAAP and are audited by companies that ensure that they do so, why should investors not trust the financial statements?
This was essentially accounting fraud and ultimately securities fraud because it induced investors to make decisions based off of false information.
Oftentimes in a corporate scandal like this one, there's a whistleblower responsible for bringing the issues to light. In the case of Xerox, this was Mr. James F. Bingham. Bingham joined Xerox in 1985 and worked his way up to the role of assistant treasurer, where he remained a loyal executive that helped guide the company through tough economic times. He was actually known to use creative accounting tactics himself, but eventually realized that the company was taking things too far in order to hide larger problems. Bingham testifies that there was growing pressure in the finance department to compensate for poor results. Xerox executives would frequently ask accountants to produce profits through accounting actions, and that it became standard procedure to look to accountants to find income that wasn't really there. Bingham says that this was all done to meet earnings expectations, but investors were not told about the accounting methods or that future revenues were being reduced. Eventually, Bingham started to feel depressed. It was clear to him that accounting was being wrongfully used to mask larger problems, and that the business was driving itself to bankruptcy. Executives inside Xerox knew this wasn't sustainable as well. Bingham told investigators that Xerox's investor relations chief warned him as early as 1999 to get rid of his stock options because the company was falling apart at the seams. The first hint of an SEC investigation came in Mexico, where the commission publicly announced that it found serious accounting regulations in Xerox's business there. Bingham recalls a meeting with the director of Worldwide Audit and a senior accounting manager, where they discussed more than $500 million in special accounting actions and the importance of Xerox doing everything it could to keep the investigation in Mexico. Bingham began to do what any employee should do in a situation like this. He sent a memo to the president and CFO at the time outlining some of his concerns, and even sent it again after his boss ordered him to take it back. Offered one last chance to state his case, Bingham prepared a 25-page presentation on his concerns and delivered the presentation to senior executives in August of 2000. Bingham had been hoping that the logic of his arguments would cause Xerox executives to change course, but later realized that he was being naive. They had already knowingly let it go on for long enough. Instead of disappearing after being fired, Bingham went public and sued Xerox for wrongful termination. He became a star witness in the SEC's investigation against his former employer, but not without a trail of collateral damage. Bingham lost friends, lost financial security, and the investigation even took a toll on his family life. Xerox described Bingham as a disgruntled employee whose accusations were based on hearsay and speculation, and even asked the court to issue a protective order to prevent Mr. Bingham from discussing proprietary material. All of Bingham's accusations were finally confirmed when Xerox admitted to its accounting fraud and had to pay a fine as well as restate its revenues over the years that it had misled its investors. However, the fact that Xerox ignored his concerns and fired him for subordination shows that the company knew it was wrong and continued to hide its fraudulent practices. The company should have brought in outside experts and debriefed him properly.
Six officers were charged by SEC for the fraudulent accounting action and agreed to pay $22 million in penalty.
CEO Paul Allaire, President and CEO Richard Tolman, CFO Barry Romero, and three other executives were charged with securities fraud and aiding and abetting with Xerox violations of reporting, books, and records.
The SEC complaint alleged that officers Allaire, Tolman, and Romero set a tone at the top at Xerox that equated business success with meeting short-term earnings targets. CFO Romero, in particular, directed lower-ranking employees in the financial department to make accounting adjustments to accelerate revenues and increase earnings.
The executives then announced this fraudulent result to the public through meetings with analysts and communications with shareholders.
They celebrated Xerox's success, even though they knew what the true operating results were.
Emails further prove that the executives knew about these faulty accounting practices.
In October of 1999, Xerox's vice chairman reported to Romero and Tolman that Xerox Europe's underlying operational results without accounting devices have been deteriorating since 1995 and are very different than operational results. In the following month, Romero told Xerox executives that when accounting actions were stripped away from reporting results, Xerox was essentially a no-growth company.
As previously discussed, the executive also ignored complaints brought up by employees, specifically for former assistants of Treasury James Bingham.
He sent out internal memos and even presented a 25-page critique on the fraudulent accounting practices, and they ended up firing him for subordination instead of taking his complaints seriously. This is not how senior management should react to complaints of its employees, especially when they are backed up with proof like Bingham's were. The SEC's Director of Enforcement noted that the manipulation of revenue and earnings through accounting devices has no place in the executive suite, and that it should be reserved for those that will tell the investing public the truth about the company's performance.
The executives neither admitted nor denied these charges, but offered to settle by consenting to the allegations.
Romero was also permanently suspended from appearing or practicing before the SEC as an accountant.
Just as the SEC stated, these executives were not displaying a proper tone at the top. They were imposing the wrong incentives on their subordinates and knowingly violating GAAP.
Not only were they misleading investors, but they were also profiting off these reported earnings.
This corporate governance behavior shows that Xerox's desire to be perceived as successful was stronger than the company's need to follow corporate governance regulations, which is entirely unethical. It is important to not just look at Xerox's internal accounting fraud, but also the company responsible for externally auditing them and protecting the interests of investors. KPMG had been Xerox's auditor for more than 40 years before the SEC investigation. This brings up the question of whether or not KPMG was aware of Xerox's accounting actions and what steps, if any, the auditing firm took to stop them.
The SEC charged 4 KPMG partners in connection with the audit to Xerox from 1997 to 2000. Michael Conway, Joseph Boyle, Anthony Delansky, and Ronald Safran. Each had been working with Xerox for a long time and knew the executives of the company well, and one was even the head of the firm's Department of Professional Practice.
According to the Commission, the firm helped executives at Xerox manipulate and distort its financial statements by issuing unqualified audits stating that the company's reports were consistent with accounting rules, when in reality they were not. They permitted Xerox to close a $3 billion gap between actual operating results and reported operating results to the investing public.
The two firms had a friendly and enduring relationship, which is part of why Xerox took such lax approach to its bookkeeping. KPMG was aware of the fraudulent accounting practices Xerox was using, and they knew that the company was falsifying its earnings. The audit partners assigned to Xerox were even warned several times that the Xerox accounting was not based on realities. But they chose to ignore these warnings and failed to ask Xerox for evidence to support its results.
In addition, auditors are required to advise companies when they discover illegal acts in the auditing process, but KPMG never did so. Obviously, as accountants, they were able to see that Xerox was violating the revenue recognition principle. But the farthest they went to stop this was to suggest that Xerox test for its accounting accuracy. However, when the company did not do so, KPMG did not press them any further.
Xerox also complained to KPMG in 1999 about the performance of one of their auditors, and the company replaced these individuals after the audit was done for that year.
As a result, KPMG was forced to pay almost $22.5 million in settlement, including $10 million in civil penalty, the $9.8 million that it made auditing Xerox, and an additional $2.7 million in interest. This money was deposited in a restitution fund for investors who lost money when the fraud was disclosed to the public, as the stock took a dive and depreciated roughly 80% in value. KPMG also agreed to undertake a series of reforms designed to prevent future violations.
Stephen Cutler, the SEC's director of the Division of Enforcement, states that this scandal highlights the critical responsibility that auditors have in the financial reporting process, and that KPMG blatantly abdicated this responsibility. The investing public counts on auditors to do their job while adhering to the principles of accounting, regardless of how well they know their client. In KPMG's case, the firm chose its lucrative relationship with Xerox over the accuracy and honesty of reporting, something that should never happen in the auditing process.
Big reputation, big reputation. Ooh, you and me, we got big reputations. And you heard about me. Ooh, I got some big enemies.
So you're probably wondering, how could this have all been avoided?
Just like filming on a day when they're blowing leaves outside, this problem could have been avoided. Xerox should have had better internal controls and adhered to ethical standards. Management was instructing accountants to violate GAAP, and there was no one speaking up about it other than Bingham, the whistleblower. Instead of taking him seriously, they fired him and tried to hide the fraudulent activity.
This was clearly an abuse of power, as the executives knew of the issue and had measures to make sure that it kept going on, even though they knew it was wrong. If there were stronger internal controls and a system of checks and balances, this would have been caught earlier.
Yeah, I gotta go film this video. Yeah, it's about the Sarbanes-Oxley Act. After this scandal, the Sarbanes-Oxley Act was put in place. It mandated strict reforms to prevent accounting fraud, including making management sign off on all financial statements. Had this been in place before, the executives would have been faced with full responsibility of the fraud and would likely have not kept it going. The Sarbanes-Oxley Act also required more frequent partner rotation for external auditors, which would have also avoided the problem if it had been in place earlier. Xerox and its KPMG partners had too much of a friendly relationship, and this is why they were able to get away with the faulty revenues for so long. An audit relationship of 30 years is way too long and should be changed more frequently in order to ensure independence.
Another simple way to avoid this issue would have been to just be honest with the shareholders. Xerox was under a lot of pressure from its competitors and investors and allowed this to compromise their ethics. Accounting for revenues up front may have seemed like a quick fix at the time, but it went on for way too long.
The company ended up with more of a loss than the loss they would have suffered if they had just been honest about their failure to meet expectations. Now, instead of just being known for failing to meet earnings for a couple of years, Xerox is known for one of the biggest corporate accounting frauds of all time.
When the SEC found out about the accounting fraud, and Xerox had to restate its profits for the last 5 years and pay out millions in fines, the company obviously took a large hit. Stock price plummeted, and investors no longer trusted the company it once had so much faith in. But what are some other lessons learned from this scandal?
First of all, this situation suggests the importance of GAAP and why public companies must adhere to it. If it were not for GAAP and the revenue recognition principles, companies could do exactly what Xerox was doing and falsifying their earnings by shuffling revenues around.
Accounting statements are meant to be an accurate portrayal of the operations of a company and must provide investors with all the information they need in order to make informed decisions. GAAP forces companies to be honest about their financials, which is extremely important in terms of the stock market.
Another lesson that can be learned from this scandal is the importance of tone at the top.
Upper management and top executives at Xerox were aware of the fraud and enjoying the fact that it makes the company look better. So they allowed it and even encouraged it. They also ignored and then fired the whistleblower James Bingham, who presented his critique to management in an effort to get them stopped.
This is a prime example of what not to do as an executive of the company. The CEO and CFO's attitude of letting it slide was a horrible example to set for employees. If employees see that management is acting unethically, they will think it is okay to do so as well.
Ethical auditing practices also played an important role in this case. KPMG's audit of Xerox was not an objective report of this company's true financials, which it should have been. They even knowingly covered for this company's fraud.
While there are generally accepted accounting principles, there are also generally accepted auditing standards. Auditors like KPMG have a set of principles that they have to adhere to, including maintaining independence when performing audits and exercising due professional care in preparation of reports.
The KPMG auditors did neither of these things and helped Xerox lie to its investors, proving that the regulation of auditors is just as important as regulating the companies getting audited.
In the wake of this scandal, and in combination with companies like Enron and WorldCom that defrauded investors, the Sarbanes-Oxley Act of 2002 was passed. It was passed to protect investors from the possibility of fraudulent accounting activities by corporations like Xerox. It mandated strict reforms to improve financial disclosures and prevent accounting fraud. The reforms were in 4 main areas: corporate responsibility, increased criminal punishment, accounting regulation, and new protections.
One important provision in the Sarbanes-Oxley Act is that the senior managers must certify the accuracy of the financial statements, holding them accountable for any fraud.
Publicly traded companies must also establish internal controls and reporting methods on the adequacy of these controls.
Xerox lacked both of these things, and if the act had been in place earlier, they would not have gotten away with accounting fraud for so long.
A final lesson that can be learned from this situation is the importance of integrity. Xerox executives were not acting with integrity, but James Bingham was. He knew that what the company's accountants were doing was wrong, and ultimately ended his career at Xerox by refusing to stand up.
While many people would just keep their mouths shut, Bingham acted ethically and took on the risk of losing his job anyway. Whistleblowers like Bingham are often ostracized and blacklisted when they speak up, but they have the power to prevent companies like Xerox from defrauding thousands of people.
Under the requirement of the SEC, the Xerox Corporation restated its financial earnings, dating back to 1997. The SEC also charged 6 former Xerox senior executives, including CEOs Paul Allaire, Richard Tommen, and CFO Barry D. Romero. The officers were charged with securities fraud and aiding and abetting Xerox's violation of the reports, books, and records, and the internal control provisions of the federal securities laws.
The 6 defendants agreed to pay $22 million in penalties without admitting or denying the SEC's allegations. These funds were paid into an account for distribution to the victims of the alleged fraud. Practices at Xerox are much different today, as the company, like many others that face similar charges, has learned its lesson. Following the $10 million settlement with the SEC and restatement of financial earnings, Xerox began its transformation, led by its new CEO, Ann Mulcahy.
Mulcahy's first step was to replace the company's entire accounting team and begin cutting costs to alleviate the company's large debts. Mulcahy's optimism in her role as CEO and the company's ability to recover was well documented, and this optimism rubbed off on employees. Mulcahy managed to change the tone at the top at Xerox, which contributed to her ability to rebuild the company into what it is today. Mulcahy responded to feedback from both customers and employees to make positive changes. She also opened up the lines of communication within the company. She did this by traveling to speak with people who would provide her with constructive criticism to help bring the company back to success.
There's no doubt that turning the company around and working towards gaining a profit wasn't easy. Employees were laid off and various corporate functions were outsourced to save money. However, Xerox is able to pick itself up.
The current CEO of Xerox is John Byzantine, and the CFO is William Osborne Jr. On its website, Xerox states that its business leaders exemplify value-based and results-driven leadership. They pave the way for the next generation of Xerox leadership to accelerate the company's growth and continue building value for shareholders. The company also now has an ethics and compliance program, emphasizing that conducting business with ethical integrity is the job of every employee at Xerox. There's a written code of conduct as well as a supplemental code for finance employees. Now, there is also a hotline dedicated to receiving questions and complaints, and a strictly enforced no retaliation policy to promote comfort in using the hotline. Xerox trains all of its employees on ethics, especially senior management. It is clear that Xerox has learned from its mistake and wants to ensure that ethical standards are followed in the future. In January of 2016, Xerox announced that it would spin off its business services unit, and did so on December 31st, 2016 with the creation of Conduit, a new publicly traded company. Xerox itself still focuses on its document technology and document outsourcing business, and continues to trade on the New York Stock Exchange with a stock price of $28.38. Though we don't know exactly the future of Xerox, we hope that they never get caught in an accounting scandal ever again.
Can I get you another round? You okay? How's the project going? I don't know. I filmed and edited everything, but I just feel like something's missing and I don't know what it is. This thing helps. Start over. It's okay. How could this? It's okay, Zach. Don't cry. For externally,
Another lesson that can be learned from the scandal is the importance of the tone at the top.
According to Gad, Xerox should have immediately
pay $22 million in penalties.
Bro.
I can't believe this. Funds were paid into an account to be distributed to the victims. These funds were paid into an account.
It's fine. You actually believe that? Should we go outside?
Boomerang.
Action. The Sarbanes-Oxley Act. Frequent partner.
This is clear. Wait, have Don go with checks and balances. It's for us to look.
Action.
Part of Xerox revenue came from of services.
Your arm.
Over the lease of
The life of the lease.
Accounting?
Maybe not.
What is the line?
falling short of revenue expectation.
Okay, action.
Only public companies are required to.
It's fine.
Stop.
Corporate governance relation. Corporate governance relation. Corporate governance relation.
Why do you keep saying relation?
No.
Yes.
I look ready.
Yeah, you do.
Itself up and list of Fortune 500 companies today. That's not. And continues to be
Oh, you almost had it.
and continues to be a successful.
Action.
You can't do this right now.
What are you can't do this right now?
What are generally accepted accounting principles?
How bad?
Go.
Is this bad?
No, you're fine.
Of services.
Excuse me.
These are good.
Yeah.
President and CFO.
It's okay.
That's just that gap's not being used.
By overstating its profits by nearly. Oh, damn it. Xerox violated accounting standards by.
Xerox should have been.
Okay.
I can't do that seriously. Oh my god. So bad. Learned its lesson.
A ghost. You think you got it?
If there were no stop.
It's okay.
They're just getting the revenues. Oh no. Just realized they don't know how to read.
SEC.
Make copies was commercialized.
In the case of Xerox. Okay, great. So Xerox gets direct.
No, it's okay.
That Xerox was intentionally a complaint that violating.
Okay, bye. Where did I lost the part of that? Hi. Hi.
Has the responsibility of adhering to a set of principles.
All have to be audited, but to be audited. Oh my god.
Are often sorry.
Ethical.
No, it's okay.
Just which it should have been.
Okay, one more time.
That equated business success. Term earnings target.
Okay.
You can beat it back.
I I know, you're allowed to be in the background.
Face similar charges. Has learned its lesson.
KPMG also agreed to undertake a series of reforms to design.
Oh.
Should I do that again?
That was so good.
Alright, we're good.